I was staring at a trading terminal this morning. One of those setups with like 6 monitors, lines going everywhere. It just looked like a spaceship cockpit. And it struck me, we think of finance as this ultra-modern, high-tech thing. I mean, we've got AI making trades, fiber optic cables drilling through mountains just to shave off a millisecond.
It feels like science fiction half the time. It really does.
It does. But then I was looking at the source material for today, and I had this realization.
Right.
The actual operating system, the logic running underneath all that flashy software.
Yeah.
It was scribbled down on a notepad by a guy in a Victorian suit, probably in some smoky newsroom over 100 years ago.
That's the perfect way to frame it. We're all obsessed with the apps of modern trading, but today we're looking at the source code.
Exactly. It's like finding out your Tesla is running on a steam engine design from 1890. We're doing a deep dive into the grandfather of all technical analysis. We're talking Charles Dow and, of course, Dow Theory.
This is arguably the most important foundation for anyone who wants to understand how markets move. It really is the bedrock. But, before we get into it, we have to do the housekeeping.
Right. The disclaimer. We are going to be talking about markets, trends, all that stuff, but let's be crystal clear here.
This deep dive is for educational purposes only.
We're exploring history and economic theory.
Nothing we say constitutes financial advice. Seriously. If you're looking to invest, do your own homework, or talk to a certified professional, don't bet your savings based on a history lesson.
Deal. Okay, so the man himself, Charles Dow. When I hear Dow, I just hear the voice on the news. The Dow is down 200 points. It sounds like an object.
Right.
But he was a real person.
Yeah.
And looking at his bio, he was not what I expected.
Sure.
I pictured, the Monopoly man. Top hat, cigar, maybe owned a railroad.
Yeah, you'd be disappointed. He wasn't a robber baron. He wasn't some Wall Street tycoon. He didn't even run what we'd call a hedge fund, mostly because they didn't exist yet.
So what was he?
Charles Dow was a journalist.
A reporter. So the guy who invented how we analyze Wall Street was just covering the beat.
And that's exactly why his view was so revolutionary. You have to picture the era, the late 19th century. It was the Wild West of finance. I mean, zero transparency.
Okay.
Companies didn't have to publish reports. They could just lie about profits. You had these stock pools that would manipulate prices to trap everyday people. It was a casino where the house was actively cheating.
So less like the NYSE today and more like the craziest days of unregulated crypto markets.
That is a very, very fair comparison. It was just chaos. And Charles Dow, with his partner Edward Jones, wanted to bring some sunlight into that room.
So he co-founded the Wall Street Journal.
Exactly. Not to get rich trading, but because he believed investors deserved actual facts. He wasn't trying to build a trading strategy. He was trying to build a barometer.
A barometer. That's a great way to put it. He wasn't trying to game the system. He's trying to measure the weather.
He just wanted to know, is the economy healthy or is it sick? Is the pressure rising or falling? And he saw this huge flaw in how people look at the market. They'd look at one stock, say a sugar company, and if it crashed, they'd panic.
But that one company could just have bad management or something.
Right. It didn't mean the whole U.S. economy was failing. He needed to zoom out.
He needed an average.
He needed a representative sample. And so in 1896, the Dow Jones Industrial Average, the DJIA, was born.
Okay, let's dig into that. The Dow. We hear that number every single day, but I bet most people can tell you what it actually is. The Dow closed at 34,000. 34,000 what?
At its simplest, it's a list, a collection of 30 massive established U.S. companies. We call them blue chips.
Hold on, why only 30? The S&P is 500. The whole market has thousands. 30 just seems, I don't know, kind of small for an economy our size.
It seems small now, yeah, but the logic was that these 30 companies are so huge, so integrated into everything, that they basically act as a proxy for the entire industrial engine of America.
So if you have Apple, Microsoft, Boeing, McDonald's.
Right. And Goldman Sachs, and all of them in one basket. If those 30 are making money and hiring people, it's a pretty safe bet the rest of the country is doing okay.
It's like taking the economy's pulse by checking the biggest players.
Yeah.
But there's a weird thing with the math, right? I read the Dow is calculated differently than the S&P 500.
Oh, it is. And modern critics, they kind of hate it. The S&P 500 is market cap weighted.
Meaning the bigger the company's total value, the more it moves the index.
Exactly. Apple moves the S&P more than a tiny airline does. That makes sense, Dad.
Sure. But the Dow?
The Dow is price-weighted. It's an old method from before computers. It effectively just looks at the share price. So a company with a $300 stock price has way more influence on the Dow than a company with a $50 stock price.
Wait, really? Even if the $50 company is actually a bigger, more valuable company overall?
Yes. And think about how strange that is. If a huge company does a stock split, their stock goes from $100 to $10, its influence on the Dow just drops by 90% overnight.
But the company hasn't changed value at all.
Not one bit.
That seems deeply flawed.
Yeah.
I mean, why should the price of one share matter more than the size of the whole company?
It is flawed. It's a relic of 1896 arithmetic when they were doing this with a pencil and paper. But what's funny is, despite the weird math, over the long term, the Dow and the S&P 500, they track very closely together. So the methodology is weird, but the signal is the market up or down is still pretty valid.
Okay, so Dow builds this thermometer, the index, but just having the number isn't enough. You have to know how to read it. And this is when we go from the tool to the theory. And the main analogy here is the ocean.
The ocean analogy is brilliant. It's so good because it captures the complexity of time. Dow realized markets don't just go up in a straight line, they zigzag.
Right.
But those zigzags aren't random. They're a mix of 3 different movements all happening at the same time.
Okay, let's break them down. First one, the big one, The tide.
The tide is the primary trend. This is the one that lasts for years. This is your bull market or your bear market. It's like standing on the beach. If the tide is coming in, the overall water level is rising.
Okay.
It doesn't matter if one wave crashes and pulls back for a second. The overall volume of water is still increasing. That's the primary trend.
So if I'm a long-term investor, putting money in a 401k, the tide is really the only thing I should care about.
100%. Fortunes are made by just figuring out the tide and then sitting on your hands. But that's so hard for people because of the second movement, the waves.
The waves, these are the secondary trends.
Correct.
Yeah.
So let's say the tide is coming in, it's a bull market, but suddenly for a few weeks, maybe a couple of months, the market drops 10%. That's a wave. It's a correction. It moves against the tide.
And this is where everyone panics.
This is the shakeout. It looks scary. It feels like everything's reversing. The headlines scream market crash. But in Dow theory, a secondary trend is just a necessary pause. The tide hasn't turned.
Well, how can you tell? I mean, how do you know if it's just a wave, a correction, or if the actual tide is turning? That seems like the most important question.
That is the trillion-dollar question. We'll get to the signals for that in a minute, specifically with volume and confirmation. But first, there's the third movement, the ripples.
Minor trend.
These are the daily fluctuations, the hourly charts. It's just noise. This is what you see when you refresh your phone every 10 minutes.
Guilty, yeah. I check it way too often.
We all do. But Dow had very little patience for the ripples. He believed they were largely meaningless, just caused by random news or a big trade. If you focus on the ripples, you'll drive yourself crazy.
So the lesson is, zoom out. Don't trade the ripples if you're trying to ride the tide.
Exactly. But there's another layer here. Dow didn't just talk about the direction. He talked about the phases of the trend. This is the psychology part, and it's fascinating.
Oh, I saw this in the notes, the 3 phases. This explains who is buying and when.
Right. Let's take a bull market. Phase 1 is accumulation. This happens right after a big crash, when everything looks terrible, the news is awful, the economy looks dead.
This is when everyone is terrified of stocks.
Everyone except the smart money, the insiders, the deep value investors. They start buying quietly. They know the worst is over and assets are cheap.
So the price isn't moving much because the public is still selling, but the smart money is just soaking it all up.
Precisely. Then you get phase 2, public participation. The market starts rising. The news gets better. The trend becomes obvious to most professionals. This is when trend followers jump in, and it's usually the longest phase.
And this is when your average person starts to feel good about their retirement account again.
And then there's phase 3, excess or distribution. This is when your taxi driver is giving you stock tips. This is when everyone is bullish, the news is euphoric, and prices just go vertical.
And this feels like the trap. During this phase, what's the smart money doing?
They're selling. They're distributing their shares to all the latecomers. They bought in phase 1 when it was cheap, and they're selling in phase 3 when it's expensive.
Wow. So the trend looks strongest right before it dies?
Because that's when the dumb money is flooding in, and the smart money is quietly heading for the exits. Identifying that phase is crucial.
Okay, so we have the ocean movements, the psychology phases. But Dow was a data guy. He wanted proof, not just vibes. He had rules of the road. And the biggest one seems to be about volume.
Volume is the fuel. Dow was adamant about this. Price tells you what is happening, but volume tells you how strong that move really is.
Explain that. If the price goes up, it goes up. What does it matter how many shares were traded?
Okay, imagine you're at an auction for a painting. If the price jumps from $100 to $1,000 because 50 people are all shouting bids, that price is real. There's huge demand.
Right.
But if the price jumps to $1,000 just because 2 guys in the back are bidding against each other and everyone else is silent, that price is fragile. It's weak.
I see. So if the market hits a new all-time high, but the volume is low, not many people are actually buying at that new high. That's a warning sign.
It's a divergence. In a healthy bull market, volume should increase as prices rise. More people should be joining the party. If prices rise but volume dries up, the trend is running out of gas.
That's a super useful tool. It's like a lie detector for the price.
It is. And then there's the other major rule, the principle of confirmation.
This is the idea that the different indices have to agree with each other.
Yes. Remember, Dow created 2 main indices, the industrial average, the factories making stuff, and the transportation average, which back then was mostly railroads.
Right. In 1896, if you made something in a factory, you had to put it on a train to sell it.
Exactly. So the logic is simple. If the industrial average is hitting new highs, factories are booming, but the transportation average is tanking, something is wrong.
Because if the factories were really selling all that stuff, the trains would be busy shipping it.
Correct. If the trains aren't moving, the factories are just building up inventory they can't sell. So Dow said for a real trend to be valid, both averages must confirm each other. Both have to be making new highs.
Does that still hold up today? I mean, we have the internet. We don't use railroads as much.
The components have changed. Now it's FedEx, UPS, airlines, big shipping companies. But the logic is 100% intact, maybe even more so. If Amazon is at an all-time high but FedEx is crashing, that's a classic non-confirmation.
I love that. It connects the lines on the chart back to the physical world.
It forces you to look at the whole economy, not just the one hot sector. It keeps you honest.
So we have tides, phases, volume, confirmation. There's one last rule I saw. It sounded like physics class. A trend is in effect until
there is a clear, definitive signal that it has reversed.
Newton's first law. An object in motion stays in motion.
Markets have inertia. And this is the hardest psychological hurdle for people. We are obsessed with picking the top. We see a stock go up for 3 years and think, it can't go any higher, it has to crash.
And so we sell, or worse, bet against it. And then it goes up another 40%.
Exactly. Dow Theory says, Put your ego aside. Assume the trend will continue until the chart proves to you, with a lower low or a clear break in the pattern, that the tide has actually turned.
The trend is your friend until it bends.
It's a cliche for a reason. Don't anticipate. Wait for the signal.
Okay, bringing this all home, it's the 2020s. We have supercomputers, crypto.
Uh,
Why do we still care about Charles Dow's notepad from 1896? Is this just a history lesson, or does it actually work?
It works, but maybe not as a trading system in the way people think of one today. We care because Dow theory is the grandfather of all modern technical analysis.
So when I see some crypto trader on YouTube drawing support and resistance lines or talking about higher highs, that's all Dow.
It all stems from him. He was the first to visualize market structure as a series of peaks and troughs. Even the most complex AI trading bots, they're often programmed to look for these same patterns: volume confirmation, trend persistence.
They just do it way faster.
Infinitely faster. But the logic is over 120 years old. The technology changed, but human psychology didn't.
Fear and greed are the same.
Exactly. The cycle of accumulation and excess hasn't changed. The tools are faster, but the human behaviors are identical to the 1890s.
But let's be realistic about the limitations. We should be fair.
Absolutely. Dow theory is not a crystal ball, and it is famously late.
Lace, how so?
Well, think about it. You have to wait for the tide to be confirmed. You have to wait for the indices to agree. You have to wait for that lower low to prove the trend has reversed. By the time Dow theory gives you a clear sell signal, the market might have already dropped 20% from the peak.
So you missed the exact top and the exact bottom. That sounds like a bug.
It's a feature, not a bug. Dow wasn't trying to catch every last penny. He was trying to capture the big, fat middle of the move with a high degree of certainty. It's not for day traders. It's for people who want to be on the right side of history.
So it's a compass, not a GPS. It tells you we're generally heading north, but it won't tell you turn left in 500 feet.
That is the perfect analogy. In a world of total information overload, Dow theory just forces you to step back and ask that one fundamental question. Okay, ignore all the noise. What is the primary trend?
It filters out the ripples.
And that is why it is timeless.
This has been fantastic. Let's do a quick recap before we wrap. We started with Charles Dow, the journalist, just trying to tell the truth about a wild economy.
We looked at his tool, the Dow Jones Industrial Average. 30 blue chip companies, weird math, but it still works.
We dove into the ocean analogy, tides, waves, and ripples, learning to tell the difference.
And we unpacked the psychology of the three phases, which helps you figure out who you're trading against at any given moment.
Then the rules of the road.
Huh?
Volume is the lie detector, and confirmation the factories and the trucks have to agree.
And finally, inertia. The trend is in effect until it's proven to be over. Don't fight the tide.
And one last time, just so everyone hears it.
This is for educational purposes only. Markets involve risk. This is not financial advice.
I want to leave everyone with a final thought. Next time you open your investment app and you see those red and green lines jumping around, just take a breath and ask yourself, am I looking at the tide, or am I getting hypnotized by the ripples?
And maybe more importantly, am I the smart money buying when things look bad? Or am I the public participation buying when everyone else is euphoric?
Ooh, that's one that'll keep you up at night. Thanks for joining us on this deep dive. We'll catch you on the next one.
Stay curious.